Welcome to All That Matters, a show about what's really worth your attention in the markets and economy today. Join hosts Michael Antonelli and Ross Mayfield as they tackle the latest headlines and answer real questions from clients.
Welcome to All That Matters. I am Ross Mayfield. That is Michael Antonelli. Mike, today we are going to talk about why the stock market, as we're recording this morning, is sitting near all-time highs, despite some headlines that maybe paint, not as rosy a picture as the stock market is giving off. So we want to talk through that. And the way that I want to do this is to use a quote from a famous person that I know. One half of All That Matters, Michael Antonelli, was in a late last week edition of the Wall Street Journal. They were interviewing some of the brightest minds on the street to ask why the market was at all-time highs. And you had what I think is like a perfect summation of it, kind of a mic drop quote, really. And it was heads, we get an AI boom. Tails, we get rate cuts and a borrowing boom. And it's really these kind of two barbell ends of the economy and the market that are driving things higher, driving this expansion in this bull market. I thought we'd talk through both of them. So let's start with AI and give it to you. What do you think about AI? How is it impacting the market? What are your takeaways from this last year of AI madness?
Yeah. I think with the stock markets, every now and then it latches onto a theme, like just a theme. It can be housing, it can be technology, it can be consumer, it could be anything. And at this current junction in time, we're latched onto an AI theme, and we're up 12.5% year to date. That's a great return. It's kind of the middle of September. Had that terrible April, but now we're up all-time highs, basically near all-time highs. And AI is one of the main drivers. We'll talk about the other one in a second. Just think about this. So Steve Jobs once said, it's not the customer's job to know what they want. And that's, I think, very, very indicative of where AI is right now. We're building something, and it's not our jobs to know what we want. It's their jobs to build it and show us, right? And it'll improve our productivity, it'll improve our lives, whatever it'll do. Just recently, OpenAI signed a massive deal with Oracle. Okay, massive. It was in the news. $300 billion. They need some cloud space, right, from Oracle. And Oracle stock was up like 35%. Crazy, just crazy. And they said that the amount of like cloud space they need, the amount of power that they need, Ross, I looked at this, the amount of power that OpenAI will need for this is the equivalent of the power produced by more than 2 Hoover dams, or the amount consumed by about 4 million homes. So think about the ripple effects of this investment. Now we need power, now we need infrastructure, just ripples through the economy, it ripples through the stock market. And this theme, this AI theme, we don't know what it'll be. Like, this is how all technology works though. When electricity was started, nobody knew what it was going to be. When the phone was started, nobody knew what it was going to be. But the stock market right now is consumed with this, and that's one of the main drivers. And that's the heads of this equation. The heads is that this continued AI boom happens.
Yeah, you nailed it. One, it's not just big tech, right? There is a narrative that it's just the big tech stocks. Obviously, they are doing quite well. So, it is big tech, but it's also the utilities, the financials, the industrials. I mean, you mentioned the need for power, like utility stocks, boring, staid utility stocks are on fire because they're providing the power for this. Yeah. And the one thing I want to say is you're talking about AI and the investment and the spending and the excitement, but it is real results like cash earnings, the things that ultimately matter to investors. And just, really importantly, because it's not just hype. It's not just some promise of something that might come in the future. The big companies are making money hand over fist today, much different from the late 90s tech boom, where there was a lot of speculation and not so much, fundamentals and growth. Today, we've got both. Like, there is enthusiasm around this idea, this theme, but it's being backed up by the earnings of the Magnificent Seven, by the contracts that are being signed for hundreds of billions of dollars, as you're mentioning. So, we don't know what it's going to look like. But the spending is there, the earnings are there, the cash is there, and the excitement is there from the biggest and smartest companies in the world. Good enough for me. The flip side, the quote unquote real economy, right?
Yep.
Boots on the ground, workers, and healthcare, manufacturing, construction, whatever. They have a tailwind that's probably coming as well. We're recording this on September 15th. The Fed meets in a couple of days. They're widely expected to cut rates, but they're also expected to keep cutting interest rates into 2026. And that's a huge tailwind for the economy. As you mentioned, it's tails. We get a rate cut and a borrowing boom. Why is that so important?
You have to remember, the stock market cares about a couple different things. And one of them is, my friends, not politics. As much as we talk about politics, much as I've tried to make this point to every single client event I've ever been to, The stock market cares about a couple things. How's the economy doing? How are the companies in the index doing? And what are interest rates? Now, there's more to it than that, obviously, but those are kind of the bulk of the major things. What are interest rates doing? Generally, when interest rates decline, that's a good thing for the stock market because financial costs start to fall, right? Consumers can borrow at cheaper rates. Homes can start to circulate more when mortgage rates fall. So we are looking at a potential rate cut cycle because the jobs market appears to be the one weakening thing right now. Inflation was the dominant force for a while. Is it back to where it was? No. We all feel the pain of expensive food in restaurants, and it's still $50 to go out for hamburgers. Like we get it, but like the jobs market has taken center stage, and the Federal Reserve now has to say, all right, look, we know inflation's still probably not where we want it, but if the jobs market weakens even more, that's a worse outcome. So we're going to start a rate cut cycle, and that's just unlocks what I said in the quote, a borrowing boom. Because think of all the HELOC money that's trapped in people's homes that they might be able to pull out because rates drop. Think about all that stimulus in the economy. Think about maybe the housing market unlocks a little bit. Maybe companies start to lean in a little bit more because rates are more secure for them. So the bottom side of this coin, this rate cuts kicks off a borrowing boom, is a little healthier, Ross, in my opinion, than just AI dominating. I'd like to see both happen, frankly.
And quite frankly, we are, and that's why it's a great call out by you, is because we're sitting here today, and just last week the S&P 500 equal weight, which is like not a big tech, it's every company gets the same weight, is at an all-time high. And the reason for that is not just AI, although that's a big part, but it's also this idea of rate cuts. A big shout out to Ross Yarrow, who's a friend of yours, a Baird employee. He had put together a chart that showed what happens to the market when you get rate cuts and no recession. Those are the only two qualifiers: rate cuts plus no recession. Because occasionally the Fed is cutting rates because the wheels have fallen off, right? They cut rates to zero in COVID because we don't know what's going to happen to the world. The Fed started cutting interest rates last year in September. There's been no recession since then. And if you look at the few times that's happened in modern history, like 1995 or the late 80s, it's been great for the stock market. Why? Because with no recession, people keep working. Lower interest rates unlock consumer borrowing, as you mentioned, might unlock all that home equity that's out there, might let companies borrow for cheaper. A lot of companies tap the capital markets to open a new factory or, build a new production facility. You've got a lot of that happening in Kentucky right now. It's great. And interest rates, lower interest rates, cost of money, it's all good. And so it really is kind of like this barbell, heads you win, tails you lose, or the quote. Don't let me bog this recording down by butchering a colloquialism. But it's a very good spot for the economy to be in. With all that said, I do want to spend the last few minutes here. We have occasionally recorded about why we're excited, and then the market turns as the episode is getting pushed out.
Exactly.
So what are the things that worry you or that are on your mind? What's your thesis for the world and what we might watch for the downside?
Yeah, remember, the stock market can fall at any moment. We're not saying that this is AI rate cuts, everything should be fine, smooth sailing. The stock market can fall at any moment. Anything could happen in the world. That's what history is. It's just one thing after another. Okay, that's what it is. So what could happen? Something that we don't see could happen. We would tell you that all the time. Something that is unseen by us. But also the things that Ross and I watch, strategists, people who kind of do this professionally, are just how's the average consumer? What are they spending? What does their housing situation look like? Do they have jobs? Like those kind of things. We watch those, and the labor market and the housing market have been a concern. That's what I think what the rate cuts will be for. So we'll continue to watch those. So how the average consumer is doing all over the country is on my mind all the time, just like our customers are on my mind all the time. I just want to know how everybody's doing. How do they feel? Are they confident, or is their confidence waning? But ultimately, when you think about the things that are a risk to your money, and the reason why we plan, most of those come out of the blue, Ross.
They do. And even if we know what that might be, I think back to just this April. Like, we knew the administration wanted to put tariffs on. That was a risk to the markets that we had talked about. And then even knowing all that, the market was completely shocked by the level of tariffs on April 2nd. So there is just an unknown factor in all of this, right? The biggest risk, and this has been one of the biggest things I've learned from you, it is the things out of the blue. It is the once in a generation global pandemic that was 2 months earlier, not in a single strategist outlook for the year 2020, right? That's the sort of thing. the one other thing I watch and a place where this could occur is AI. Like we had all this AI spending, this AI bull market. We love it. We love it today. But then in January of 2025, an unknown AI program out of China, DeepSeek, sends NVIDIA and all these like impenetrable companies crashing for a brief moment. So this idea that we're focused so much on AI, but what if we don't need to spend so much? What if a lot of this spending is not a good return on investment? That's something that I'm thinking about all the time. It seems like we're in a good place, but ultimately we'll find out, right? Mike, there's a crisp in the air. It's fall. I know you want to get off a take here. You've always got a take. It's one of the things I love about you. Let me have your fall take.
Okay, here's my fall take. People are going to hate this. I know I'm going to get hate mail. I don't know if I've said this. I think I've said this around my office, but the 3 best months of the year. Okay, I'm going to tell you what the 3 best months of the year are. Number 1 by far is October. I'm going to get so much hate mail on that, but October is the best month of the year. You get the football still there. You got nothing better than pumpkins. I think pumpkins are the most underrated thing in the world. I love Halloween too. The second best month of the year is December. Just everybody's in a good mood. The year's over. You're kind of winding down, and that first snowfall, and at least where snow falls is so special. And I'll throw the third one out just for all the summer lovers. I think it's probably July, because this is your lake time. This is the 4th of July's in there. Like this is when the summer really starts to ramp up. But I do think my hottest take is that October is the single best month of the year.
Honestly, I don't hate it. We'll see what people have to say, but perfect weather, football, chilly, like all the things you want. July, I don't know. I can't get behind you there, but you know what? Generally, like you certainly served up takes that I've disagreed with more. So anyway, it is mid-September, October right on the horizon. Mike, good to talk to you as always.
Thanks for watching All That Matters. Opinions expressed in this episode belong solely to Mike and Ross and do not necessarily represent the opinions of Baird. This program is for informational purposes only and should not be relied upon for any investment decisions.